Hello everyone, welcome back to my channel. In this video, we will continue our discussion on the third chapter of 10th grade CBSE curriculum, Money and Credit. We will cover why poor people still depend on moneylenders, how self-help groups are game changers, case study of Grameen Bank of Bangladesh. Let's break it down. Even though banks and cooperatives are formal sources of credit, many poor households still borrow from informal lenders like moneylenders. Why do poor people still go to moneylenders? The main reasons are: number one, banks are not available everywhere, especially in remote villages. Second, banks ask for documents and collateral like land or house papers. Third, poor people often don't have collateral, so banks reject their applications. Fourth, money lenders know the people personally, so they give loans even without collateral. But money lenders charge very high interest, keep no records, and often harass the poor when they can't repay. So what's the solution? Self-help groups. Yes, the SHGs. This is a powerful idea that is helping many poor people, especially women, in rural areas. Let me explain what is a self-help group. So a self-help group is a small group of 15-20 poor people, usually from the same village or neighborhood. They come together to save money regularly, maybe 25 rupees, 50 rupees or 100 rupees per month, depending on what they can afford. These savings are collected and used to give small loans to members for emergencies, businesses or household needs. The interest is low, much lower than what a money lender would charge. And if the group has been saving regularly and managing well, the SHG becomes eligible to get a bank loan. Yes, the loan is given to the group, not just one person. The SHG decides who will get the loan, how much, what interest to charge, and how long to repay. The entire group is responsible for repayment. So if one person delays, others follow up seriously. This makes the bank trustworthy of the group, and even if the members have no collateral. People use SHG loans to buy seeds, fertilizers, raw materials. They can start a small business like weaving, stitching, dairy, or shopkeeping. They can release mortgaged land. They can buy housing materials or tools like sewing machines, hand looms, cattle, etc. This creates self-employment and income. Now, SHG also empowers women. Yes, SHGs are not just about money. They also give women confidence, a voice in the community, a platform to discuss important issues like health, hygiene, domestic violence, and child education. It helps them become financially independent and socially stronger. Let's do a quick recap, the key point and their explanation. Why poor avoid banks? They have no collateral, difficult process. Why they go to money lenders? Easy to get loans but high interest. What are SHGs? Small saving groups that help each other. Benefits of SHGs: easy loans, low interest, women empowerment. Bank loans to SHGs given without collateral based on group trust. Moving on, let's understand why credit is so important for development, especially in poor communities, through a real life success. The story of Grameen Bank, a model from Bangladesh, where a revolutionary idea changed the lives of millions of poor people. Now, what is a Grameen Bank? Grameen Bank started as a small project in the 1970s by Professor Muhammad Yunus. He had one simple belief: if poor people, especially women, are given small loans at a reasonable interest, they will use it wisely and repay it responsibly. And guess what? By 2018, Grameen Bank had over 9 million members across 81,600 villages in Bangladesh. Almost all borrowers were poor women. These women use their loans to start small shops, do tailoring, buy cattle or poultry, run vegetable stalls or handicraft businesses. These women proved that poor people can be trusted to repay loans, they can run successful small businesses, and they can become financially independent. In fact, Professor Muhammad Yunus, who started the Grameen Bank, received the Nobel Peace Prize in 2006 for this endeavor. Now let's do a summary of what we learned in this chapter. Number 1, modern forms of money. We use currency, notes and coins and deposits in banks as money. These deposits can be withdrawn or transferred. This makes checks and ATM cards possible. Second, role of banks. People deposit their savings in banks. Banks give loans to borrowers using this money. Third, what is credit? Credit means borrowing money with a promise to repay it later. It can help someone grow a business or manage in emergencies, but it can also be risky if not repaid. Fourth, sources of credit. There are two types, formal sources and informal sources. Formal sources can be taken from banks and cooperatives, informal sources from moneylenders, relatives, traders, etc. Formal loans are cheaper and supervised by the Reserve Bank of India. Informal loans often charge high interest, especially to the poor. Fifth, the problem. Rich households easily get formal credit. Poor people still depend on moneylenders because they lack documents or collateral, banks are not easily accessible, and they lack knowledge. The solution: we need more formal credits in rural areas, better access for the poor to banks and cooperatives, more support for models like self-help groups and Grameen banks. Now, credit is like a tool. If used wisely, it can change lives. If misused, it can trap people in debt. So, what's the goal? Give cheap and fair loans to everyone, especially the poor. Help them build small businesses, they become independent and contribute to the economy. That's how we move toward real economic development. That is all for today. You'll find the notes next. If you enjoyed learning, give this video a like, comment your thoughts, and subscribe for more fun and easy lessons. Thank you.